Hello. A P/E ratio of 10 that has been going down for a while. Free cash flow of about $5.6 billion. What's not to like from PayPal? This is numbers that you would salivate for. But is the company actually a buy? This is what we're going to examine in a lot of detail in this video. Because we don't just rely on numbers, numbers are important, but we will see the actual story, what has been going on with the company. And I like to start with the AI deep dive because this is a great framework that analyzes the latest report, Q3 2025, that is the very latest one. And there are a couple of things that you really need to understand and know about before deciding to buy the company if you are looking to buy it. Because the price is actually there, but what about the actual operations? So, very important thing, there is a fraud spike right now in PayPal. A 50% jump in fraud hits the bottom line, hits the net income, that is, the final income. Transaction losses spiked to almost 400 million this quarter, that's a ton, and current reserves are too thin to cover the new higher loss run rate if this trend continues. Big cybersecurity issues, and the thing you have to realize is that PayPal is acting like a bank because they have a buy now pay later type system when they have to actually lend money to people that are using their services. And the thing is, when you do that and you are effectively becoming a bank, you also need to have a reserve. So for the loans that go back, there is like a reserve ratio also, which indicates how much money you are actually reserving to pay all these faulty loans if they go bankrupt, pretty much, if they cannot be serviced. Now, as you can understand, there is two things here. There is also the fraud. There is the fraud, the fact that it's basically lost money because, this is from operations. It's like a security issue, money gets stolen and all that. They lose a ton of money there, which is very substantial. And also, they lose money from being a lending machine, pretty much, a lending operation. The thing is, PayPal doesn't really like that anymore. And you can see it in the stories pretty clearly here. The $7 billion loan machine depends on strangers' cash. So PayPal relies on selling its loans to third parties to keep the engine running. And also offloading 65 billion in loans to clear the balance sheet as a massive deal to sell European BNPL loans aimed to free up capital and cut credit exposure. What does this mean? Now consider this. PayPal right now, because they have this program with basically lending money to clients, customers. What they do is that they service a lot of debt, pretty much. So they have debt from the customers that could potentially go bad. And what does this mean? This means a ton of risk. So if loans go bad, they have to actually pay it from their own balance sheet. So they have to spend their own money for this. This is something that they don't like at all, and this is why they are actively trying to sell this debt to other counterparties, to other parties. Think about it like a collector service. Now, this case is like $65 billion in loans that are European loans, so they don't have much faith in Europe here being able to pay back their credit, and so they want to get rid of these. And so they move the goalposts on credit losses. All these stories are fantastic here, painting the exact picture. By shifting loans to held for sale, PayPal can reverse bad debt reserves and hide real credit costs inside restructuring. What does this mean? This means that they actually look to send these debts, these loans, to another party, so sell them, held for sale, and once this happens, their reserve ratio goes down. So now they have to reserve less money for cases where things go bad. And this means they can actually utilize this money for sort of like increasing their top and bottom lines, pretty much. Basically their bottom line. Their net income pretty much becomes better. So you can understand the story here for the company, right? It's a company that is actually handling massive fraud. They're not doing well. They have issues with cybersecurity, very important. They need to do much better. And they also move the goalpost on credit losses. They don't like the loan business. They like getting money for it, but they don't like handling it because there's a great risk. And again, all these tell you the actual story here very nicely. Now, if you take a look at the key stories, you also see that the wave of fraud is eating their profits, selling off loans hides how much they could actually owe, and also buying back stock and paying dividends leaves less of a safety net because they have been doing that a lot. We'll talk about it because for the most part this is a good step, I think, and this is a good plan. A massive tech overhaul and government watchdogs create a messy situation as they are trying to save $280 million a year by moving all their data to the cloud and cutting staff. It's going to take years and cost a lot of money up front. So there's a story that you need to know about. And more money is moving through the app, but the quality of the money is mixed. And we saw that with potentially even the fraud here. The total amount of money sent went up 8%, and they have about 438 million people using it, which is obviously huge. They're making money. They're making more of their money from interest and fees on loans rather than just taking a small cut of every sale, because that's the typical business plan for PayPal, like 2 to 3% of the sale, right? That's what they do when they make a sale. But loan income is much riskier. See what we exactly were talking about. Now you know the exact story about what is going on with PayPal, and I will explain also why it went down, because that's not the reason why it went down. Now, before we do that, I want you to see the P/E ratio, because it has been going down, obviously, with the stock price going down, understandably so. And outstanding shares, what I mentioned earlier, notice that they started buying in 2021. And if you take a look at the 5-year chart here, you will see 2021 was when the price was high. But good for them, they actually, for the most part, bought when the price was low. And so they have been buying a ton of shares as the stock price was going down, effectively not really destroying shareholder value by buying a stock that's too high, but potentially offering value to shareholders. So do you see that? Like, for instance, if the stock doubles, now they bought back shares and retired them that were worth much less than the actual company is worth. So it could be a good move. Meaning that if the operation goes well, if operations continue to go well, you can have a massive push from PayPal financials. And even though it's down tremendously from its highs, if the story reverses, and it could, we will talk about it, then you could see a massive spike because of this. Because now it's going to be almost like a double push. Makes sense? I think it does, right? Now, their total equity has been going down because of the buying. They have been buying a ton of shares. But look at this. The revenue hasn't really decreased. Now, the trajectory is increasing. It's kind of sloping a little bit, sort of like, not so much as it was before. It kind of becomes a little bit more steady, and we'll talk about it. But still, it's going up. And it's not actually, they don't even have a year where they actually went negative. And they have been hammered. Now, the net income of the company also going up. So again, they are making money. It's not like they are losing a ton of money or anything. Now, their margins have gone a little bit lower, potentially even because of competition, like the likes of Apple Pay, for instance, are big problem for the company, big competition, obviously. But it's not something that could actually, again, mean that the company should be punished by like 80% of their stock price. That would be insane. This usually happens because the company was overpriced to begin with, and because it was a sort of like a rocket story, like an investment story that will be growing, like it was like the payment company. Everybody was expecting the most, but then all of a sudden, because of Apple Pay and all the other competitors, they are just another financial services company right now, another payment processor, pretty much. So this is one of the core reasons why this has been heading downwards, because there's not this this expectation of tremendous growth, pretty much. And you can kind of see that also, this slow in growth from the revenue that the company generates, because it has been growing, but not as much as before. Like, for instance, you see we had 80%, 20%, 18, 15, 20, but here we're seeing like 6%, 8%, 3%. Sort of like becoming value territory, or sort of like closer to a blue chip company instead of an insane growth story. And, the Wall Street and traders don't really love that situation, is the thing. But however, as an investor that's looking at this and they're like, you're actually trying to find value, this is very appetizing. It looks pretty interesting to me. And the net income of the company, again, has been growing. It's not like it's going down. So see, net income also going up. You're not looking at a company that's going bankrupt or anything. Like, this is a pretty solid company here that has been hammered. So for an investment through the years, this sounds like an interesting opportunity to me. Very, very interesting. Like, take a look at the retained earnings. Pretty much skyrocketing through the years. That's what I love to see. The company has been doing seriously well and also buying back treasury stock. So, there's not much to not like here. Now, you will also notice that the free cash flow has been pretty much heading upwards for the most part, but kind of a little bit steady in the later years, because again, these things haven't been increasing tremendously for them in the latest few years. Spending a little bit more on capital expenditures, but for the most part, yeah, they are sort of like seeing a little bit of a steady growth now, going back to almost like a little bit of a more growth territory than the steady stuff that they have been doing in the past few years, steadily and slowly though. Now, the other thing that we are going to examine, actually, let's first take a look at insider trading, because I always like to see that. This is extremely important in the case where you see discretionary sales, and especially high discretionary sales, because these happen, they are not pre-planned. Usually, when you have insider sales, there are two ways to sell. You have to file a form, this form, 10b5, and you have to file it months before. It's like a mandatory, like 3 months cooling off period. But this one is discretionary. You can actually call tomorrow and be like, okay, I want to sell tomorrow. You have to sign some sort of paperwork, and it's going to be a discretionary sale. And this is something that you need to be paying closer attention to. Now, this lot is not that high, so I'm not really worried about it. And I also examined the previous quarters, and they look like similar. So it's like there's like a discretionary sale, which is like the same all the time. And I'm not seeing like tremendous sales here, is the thing. And I always examine the CEO and the CFO of the company. This is a CEO, pretty much. Very interesting, but nothing to be alerted by in this situation. Now, stock alerts. This one, and I like to use the charts here, this is a fantastic representation of what's going on with the company, I feel. And if you want to take a look at all these, you can go to stockainsights.com and examine this. Accidentally, I'm using the local host right now because I was developing some things. But yeah, stockainsights.com is where you will find all these, and there's a free account. So, you will notice that their margins about the same. So, steady, holding steady through the quarters as well. So, it's like a 4 out of 5. Capital efficiency of the company, solid, very solid, about 18%. That's like $18 on $100 invested in the business. I'm not going to explain everything here because it's going to take a lot of time if we actually explain everything. I have done it in the previous videos. If you want me to, I can make maybe even a dedicated video to explain all this. But basically, this is about how much money you make on the capital that you have already invested in the business, and the return on incremental invested capital is how much more you gain on the new capital that you invest into the business. Incremental margins is the same idea. Now, this is going a little bit sideways, going a little bit worse. Because the company has been having a lot of competition, obviously, but for the most part, you are seeing an about 16 operating margin to about 21 as an incremental margin. That is again on the new revenue. Earnings quality is about the same for the most part. That's operating cash flow divided by net income. It's a ratio, and the free cash flow quality pretty solid here as well. Strong earnings here converted to free cash flow. That's what we like to see. And light capital needs. Obviously, this is not a heavy capital expenditures company. Debt coverage, it's 1.7 years, and you may be seeing slightly yellow, but you have to remember that this company is actually operating loans. So don't take this much into account. On the other hand, it's actually even good because they're operating even utilizing all those debt because of the loans, and they still have a debt coverage of 4. Is pretty awesome. Share dilution, we saw the company buying back a ton of shares. That's nice here. And stock compensation and buyback quality also a 5, because this is how much the company has been buying back in shares and how much they have been giving back to shareholders, to employees as a stock-based compensation, this thing. And you'll notice that it was way extended here, and now it's getting much better. So from 42% to 21%. These cards are fantastic here, explaining the situation. Goodwill risk of the company. They had some acquisitions like Venmo and stuff, but nothing really that actually eats on their goodwill here, so they don't have to do any write-downs and stuff of that sort. Receivables quality, collections improving, but that's not a huge thing here for PayPal. Asset maintenance is probably also not very, very important for the company, but they do spend more on capital expenditures lately. And accruals quality, it's also pretty solid here, much better than the $100 sort of like baseline. Depreciation adequacy is another thing that's probably not important. It's a light company in terms of capital expenditures. This would be more important if we're looking at the likes of Netflix and things of that sort potentially, where there is amortization, for example. Altman Z, now you look at this 2.8, it may scare you, but I have a warning here because that's important. This has limited relevance for payment processors because they handle debt. And so the structure differs from formula assumptions because the Altman Z was created many years ago, decades. And so the financial services is a new thing that handles that. You cannot really use this kind of formula here, so this is why the warning. It's still nice to know, but it's going to be affected by this, understandably. And so this doesn't really mean that the company is obviously close to bankruptcy, actually the very opposite. Okay, the last thing to do, stock evaluator, just to see the cash flows of the company, how strong they are. And we're going to use the typical model that we use, and the typical assumptions. 9, 12, and 15 revenue growth, 17, and 19, and 21 are the typical. This is the about average revenue growth that the company has. And the margins are about 20% here for free cash flow. We go a little bit lower, somewhere in between. Now, the revenue growth is a little bit optimistic here because it has been trending downwards recently. So if we calculate intrinsically, you will see that this is a cheap company. If we go towards the later sort of like revenue, which has been trending down, and we become a little bit more conservative here, then we are still going to be getting fairly solid values, fairly solid values here with about 58, 84, 16. But again, if we go maybe a more conservative, like a Warren Buffett conservative, you will see that all of these are kind of like green. So because the stock obviously has been suffering tremendously, even though they have making good free cash flow. So the verdict for this, for myself, is a company that's doing well, has been battered down because of expected competition. It's not the growth story it was in the past. But in terms of what they are doing, at least for now, this is a nice buy. So I would potentially definitely look to buy this one and hold through the years. It would have to be something really extraordinary to actually make this company go really, really south. And that's not something that you see right now. On the other hand, it could be the opposite situation. You could see a company that all of a sudden actually skyrockets. And I told you about this earlier, especially with the buybacks that I have been doing. Thanks for watching, guys. Tell me what you think about the company and leave a like on the video. That helps a ton. I'll see you soon. Bye.